Welcome to a critical point update of the economy. This is a macroeconomic update relative to our business cycle models. I'm Rich Pawson. Okay, it's January 7th, 2021, and we recently received updates of PMIs as of December. Now, PMIs are an economic indicator. You can find them for manufacturing, services, as well as a combination, and they are published once a month. Now, these PMIs give insight to the economy in that there's a strong positive correlation of PMIs to GDP, or I should say percent GDP. So the bottom line is, if a PMI is moving above this 50 break level or threshold, then the economy should be growing. And at the very least, the PMI is suggesting at least the services or manufacturing or both are expanding, okay? Now, the higher the PMI, the faster the expansion or growth. When the PMI drops below 50, the economy is moving backwards, it's contracting, it's losing ground. And if it drops to near 45 or lower, most economists, including myself, assume the economy's in recession. Now, I prefer, if it drops to 45 or lower, I prefer to see it corresponding with the long-term business cycle model that's suggesting, yes, we should have an economic downturn. Then that raises confidence that we are in a true recession, okay? So there's many different types of business cycles ranging from a few years to hundreds of years, believe it or not. And so that's why economists, I think, get themselves in trouble and have a difficult time forecasting. They don't understand all these different multiple time frames that are going on, these different types of trends, and they summarize things maybe too much and incorrectly. One of those business cycles is called the major long-term business cycle. It's also called the LT3 cycle, and it's also called the 9-year cycle, and I'm using the 9-year as labeling on this chart. And this specific business cycle can be found in economic circles and even on the internet as the juggler cycle. It's the same cycle, but my time definition is different than theirs. I count a little bit different. Otherwise, it's the same cycle, and I believe this cycle since the 1800s for the U.S., when it has turned down, we have always had a recession, if not a depression. And currently, it looks as though we just seen a collapse into a recession, if not a depression, as of 2020, for a 9-year business cycle bottom. And it correctly called during the summer months and fall that looked like we were pulling out of the recession. It probably bottomed, the cycle bottomed, at least for the PMI. And we can now see, as of December, the PMI surged, exploded to historical highs since 1990s. This is suggesting the economy is speeding its pace of growth, and it is growing. Now, the problem is our economy, when you look inside of it, is more of a K structure. Part of the population is doing well to now very well, and part of the population is hurting, suffering, but some of those are improving. Eventually, we'll bring up that lower part of the K, the other shoe that dropped. I think we'll bring it up by late this year that they would have recovered. And in the meantime, the overall economy will probably fully recover, meaning we are going to see positive GDP this year on a percent basis. I think we'll even see nominal GDP per capita as a number, showing that the economy will be record large, that we'll see that by at least the end of the year. Okay, so this is a good leading indicator in my opinion. Now, what is the 9-year business cycle? Well, when you look at time cycles, which is what we're using as the analytical tool for these business cycles, time cycles are mostly about time, not about price, not about the amount of change of data. It is that, but it's more emphasized on the amount of time from, say, bottom to bottom. So we had a recession here, and then growth, and then another recession. We measure the amount of time from recession to recession, bottom to bottom for this indicator. And again, and again, and again, and again. And the definition is 8 to 13 years. Every 8 to 13 years, you should expect a bottom from the bottom that just occurred. So the next recession is due towards the end of this decade. It's basically a decade kind of cycle. Likewise, in between, there's probably going to be a top every 8 to 13 years. So sometime later this decade, we'll see the best of the economy, the largest of the economy, but we're also going to see peak economy, and we're going to set ourselves up for another downfall. And it's usually consumers and businesses make up 80 or 90% of GDP, our economy. So we'll probably be blaming them more than government. That's only about 10% or a little bit more, okay? But all of these can be entangled and interact with one another to cause the next downturn. Now, this PMI indicator can only go so high, and eventually it will stall out and even erode, but the economy will continue to grow, and GDP even may pick up. So the point is, we're getting some of the better of PMI right now. That might not be reflecting, in other words, the economy might not be as good as what the PMI is reflecting, but the PMI is reflecting that we've turned the economy around and the pace is moving forward. Now, I have another version of PMI that I call the economic trend indicator or econ trend indicator, and it's simply cumulative. Meaning, if this month's PMI is above 50, then I'm going to add that number to the prior month's econ trend indicator number. And if it's below 50, I'll subtract it. And if it is 50, I do nothing. I leave it unchanged. What this does is it seems to eliminate some of the entry-year fluctuation, intermediate trend fluctuation, some of the fundamental business cycle type fundamental stuff. You could say it even reduces some noise. And the other thing is smooths it out so that we can actually see the 9-year business cycle. Okay? Recession, early 2000s. Boom period. Growth. Stock market was bullish. Okay? Then we went into a recession. Stock market was bearish. Economies declined. People lost their jobs. Businesses went out of business. And that happened to be something related to supercycle, so it was a great recession. It was close to being a depression. Then we got another boom period, and then we get another recession, okay? And now this indicator's already at a new high, another signal we're moving on our way, and this also runs a very strong positive correlation to GDP. Or I should say to nominal GDP per capita. So if we plotted nominal GDP per capita, we'd see something like this. And the bottom line is, this is forecasting. Yes, the economy is going to be record large sometime this year, and should continue to do so this decade. So what it really tells us is, for some reason, it takes us about 7 to 12 years to grow and build our economy, but then we hit a brick wall where we cannot borrow anymore, or it's too expensive. It's too expensive to hire more people. It's too expensive to expand business or buy businesses. We back off. Pretty soon we become concerned that why are we backing off? And pretty soon people are trying to cut costs too much, and pretty soon they're laying people off. And then we get this fear, and the fear leads to actual destruction of business, which leads to more fear, which leads to even more destruction of business. And the next thing you know, you've been fooled that what you thought was just a normal decline in business, a little speed bump, a hurdle, a little correction in the stock market, has now gone even worse. You're moving into a recession, and now you're behind. Which is why it's important to have someone like myself trying to figure out when you're going to get those moments when, hey, this is just a speed bump, don't worry, economy is going to move on, stock market's going to move still higher, versus, you know what? Trouble's coming, another storm's coming. I'm Rich Pawson. Contact me at rich@ag-financial.com. Sign up for my podcast at criticalpoint.podbean.com. Give you a few commodities, the economy, climate, crop risk, lots of stock market, and a little bit of bonds and gold and interest rates, okay? And certainly, again, the economy. Thank you for your time and consideration.